Thank you, Brandon. Well, hello, everyone. Welcome to Unpacked. My name is Leslie Espy, and I manage communications in the community for Gravy. Some of you are like, what's Gravy? You're joining us for the first time. Well, Gravy was started this year by Brandon Jones, and the community focuses on leveling up wealth strategies through our conversation series, which are monthly, our weekly newsletters, and our Slack group. So we do encourage you all to get engaged. Today, we're kicking off our first conversation series, and our host, Brandon Jones, is our founder, and he will be speaking with Arthur Johnson on how to build a real estate portfolio. We thank you so much for being here. We encourage your questions and appreciate your time and look forward to engaging with you this evening. Off to you, Brandon.
Thank you, Leslie. Thank you, everyone, for joining us for the first inaugural Unpacked episode featuring Arthur Johnson, who I affectionately call AJ, who will be speaking about his experience building a real estate portfolio while also excelling in his corporate career, being a family man and also a man of the community. As Leslie mentioned, Gravy is really a community that's right now geared in three different focuses: a newsletter that's weekly, a conversation series. This is the first one, which will be monthly, and also our Slack group, which is daily. So please join. You'll get a follow-up email if you attended this webinar with more information. With that being said, I am going to welcome AJ, who is going to speak a little bit about, an intro, so to speak, of your journey, where you're from, who you are, AJ.
What's up, Brandon? Always good to talk to you, man. Always good to see you. Thank you for having me on the inaugural Unpacked series. I appreciate that. My story is fairly simple. I'm a first-generation American. My parents were born and raised in the Caribbean, in Trinidad and Tobago. They immigrated to New York, where they had my sister and I. We were born there. Unfortunately, my parents divorced when I was young. And so after a few more years living in New York, we decided to move to LA to get a fresh start. So I played sports my entire life: baseball, basketball, football. And the good thing about being in California, you can play sports year round. And so I excelled at baseball, earned a college scholarship for that. And when it came to deciding on a major in college, I was always good with numbers and math. And so I gravitated towards business. After college, I went to work for the government at the Treasury Department as a bank analyst. Did that for about 3 years, which was fun, but I wanted to get to Wall Street. And so I decided to go to business school. So I went to Stanford Business School and decided to use it as a way to get to Wall Street. So I worked on Wall Street for about 5 years, and it was great work, really hard. And then I decided to go in-house and work at several corporate companies doing corp dev and M&A. I was lucky enough to work at companies like Hewlett-Packard, Cisco, also worked for small private companies like Twilio. And I worked in various functions like strategy, M&A, operations. And that's been my career in technology. On the personal side, been married to a beautiful wife for 20 years. I have 3 beautiful daughters who are now all teenagers now. And last but not least, I'm a die-hard Lakers fan. So I'm feeling pretty good about last year's championship and feeling pretty good about the repeat that's gonna happen this year.
Nice. Thank you, AJ. And I was fortunate enough to meet AJ when I first moved out to Silicon Valley from New York. It's been a while now. I want to say it's been about 7 years when I met AJ. Beautiful family. Definitely are the closest things to the Huxtables I've seen out here in the Bay Area. With that being said, so AJ, you're here because as you've kind of moved through your career, you've also been entrepreneurial. You've been building a portfolio of real estate properties. I guess the first question is, when did this spark first come into your mind? At what point did you really start to say, I'm going to take this seriously? What was your objective?
So it's funny. So my initial financial goal was actually based on a seed that was planted when I was 16 years old, right? So I was working for this pizzeria, delivering pizzas, and the owner would drop by every now and again. And I looked up to this owner. He had nice clothes. He had a beautiful girlfriend, a nice car. And it turned out, in addition to the pizzeria, he owned real estate in Los Angeles. And he told me one day the key to building wealth is real estate and passive income. And he said, I make money doing this. I make money when I sleep. He said, for me, if you don't come into the pizzeria, you're not going to get paid. But for me, I can come and go as I please. I could take a vacation, but I'll still get paid. And that kind of planted the seed for me way back then. And I always thought about real estate, but never kind of moved on it or took advantage of it. And then you fast forward about 15 years later, I'm working for HP, right? And I'm working hard on this deal, but I felt stuck. I felt like I wasn't being appreciated. There was a lot of political BS going on at the company. And I just was also getting hit hard with taxes. And I was like, is this all there is? And so I talked to a colleague at HP, and he was investing in real estate. And I said, okay, that's my cue. That's my signal to get off my butt and get serious about investing in real estate. So my goal at that time became, I want to create a growing, tax efficient, passive income stream to give me more flexibility. And that's how my whole journey started.
I love it. And when I think about AJ, I think about a numbers guy. He's corporate development, ex-banker, the guy who definitely is about the numbers. And so when I saw that he stepped into the real estate hustle, I already knew, sometimes you just got to do what smart folks do. And AJ realized early on that was the best route for him to achieve, I guess, what you can call financial independence. So the next question is, and AJ, you can speak to, I guess, where you are in your journey towards financial independence. I think it's helpful for people to know not just the work that went into it, but the patience that also goes into getting to to the promised land, so to speak. So the question is, tell us where you are in that journey. The second piece of the question is really getting a sense of within your overall portfolio. So yes, you have real estate holdings. Yes, you're building passive income, but how are you thinking about your portfolio overall? Stocks, bonds, what have you, PE, VC investments. Curious to kind of hear how you're thinking about kind of portfolio diversification.
That's a good question. So I'm still on my journey. I'm still trying to create and build wealth. And if I look at my portfolio allocation, today I'm sitting at 40% equities. This is a mix of large cap index funds at Vanguard, some mid cap, some small cap, 36% real estate. That includes my investment portfolio and my personal residence. 20% fixed income. This is the bonds and also mortgage notes. And then about 2% in venture capital and 2% in cash. And this is kind of the right mix for me right now. I think that before I started doing real estate, I was heavy in equities. And then I decided to get more diversification and move into real estate. So I think this mix is a good mix for me right now.
Got it. And by the way, feel free to ask questions in the community. Leslie will be capturing the questions, and after maybe 4 or 5 more questions, we'll start to go into the audience to make sure we're giving you what you're looking for. So AJ, people say passive income. This is a word that's thrown around a lot. I've in a previous life, I've managed a few properties myself. Oftentimes, what's called passive doesn't really feel passive, and so you set up your situation where maybe it'd be helpful if you actually did a geographic breakdown of how many properties you have, where are they based, and how you actually created, what you would consider to be passive income, and how you're thinking about kind of that definition of passive and what your criteria was to meet that, and not necessarily giving yourself another job. I think for a lot of the audience here, we're working professionals. The last thing we need is to sign up for something we think is passive, and then ultimately, you're putting in some serious hours and gray hairs, and it was unexpected. So let's help people go into the journey open with their eyes open wide.
Yeah, so I think for me, I really tried to hone in on the 3 principles of growing, tax efficient, and passive. Because if I really wanted truly passive, I'd just invest in stocks and that'd be very passive. But I wanted it to grow automatically, and I wanted it to be tax efficient as well. And so those are the 3 things I held down to. And for me, like long-term buy and hold real estate fit that asset class. And I also saw a lot of wealthy people also made their wealth in real estate as well. And so I think dividend investing is another kind of thing that fits the model. It's growing, tax efficient, and passive, but the cash on cash returns aren't as great. And so I looked at this real estate. I said, I have to find the thing that had the highest ROI on my time. I had a demanding career, a growing family. And so I said, what is that going to do? So I said, for me, I could do fix and flip, which took more time, less money. I could do wholesale, but that didn't fit the model. So I honed in on long-term buy and hold real estate. And when it came to the type of properties that I wanted to pursue, I looked at single family homes, duplexes, multifamily, commercial, strip malls. And I thought, what's the best property type that's going to fit my model? And so for me, I knew more about single family homes. I knew more about duplexes. And it's easier to get into those because on the commercial side, it takes more money. And when it comes to financing those properties, they rely on the income from the property and not your personal income statement. And so for me, I felt that single family homes and duplexes was easier for me to get into, easier to finance. And when it comes time to sell the property, when you sell a single family home, you have a widest audience possible. You can sell it to owner occupied, a family, or you can sell that to an investor. On a commercial property, you can only pretty much sell that to an investor. Another thing I would say about single family homes is that the tenant you attract tends to be more stickier. They tend to have less turnover. And so if you have a 3-bedroom, 2-bath home compared to a 1-bedroom, 1-bath apartment, you're going to attract a family in a 3-bedroom, 2-bath home. In a 1-bedroom, 1-bath apartment, you're going to attract a single person or a couple, but they're going to be more transient. And so for me, I wanted to have a stickier tenant, less turnover, because turnover eats into your profits like crazy. So right now I have 10 single family homes. I have 15 duplexes. I have 3 triplexes and 1 fourplex. And I'm invested across 4 states in Texas, New Mexico, Indiana, and Wisconsin. Most of my properties are in Wisconsin and Indiana. I have 1 in New Mexico, and I have several in Texas. And so that's kind of how I have things split up and why I decided to go the route I did.
Okay, and I see a lot of folks want to hear about that first experience buying your initial property. But before we go there, I think it's important for this group who I would say are probably working professionals. You're talking about tax benefits, tax efficient growth. Can you help double click on that a little bit? Help people understand what types of tax benefits they can expect as a full-time corporate employee.
Now, I'll go into this, but I want to say I'm not a tax professional.
Of course.
Take my advice. But what the beauty of the real estate stuff is that, so there's 2 things that really help the tax benefit. One is depreciation. Okay. So if you buy a home and you take it's combined with land and improvements, the land cannot be depreciated, but you can depreciate the improvements, and you depreciate that over 27.5 years. And that becomes an expense on your tax return. It's a non-cash expense. And so although it's an expense on your tax return, it's not coming out of your pocket. And so it reduces your taxable income. That's one key tax benefit of investing in real estate. The second one, which is more complicated, is called a cost segregation analysis. You can kind of value your furniture and fixtures, your appliances, and you can depreciate that over a shorter period of time, over 5 years. So you get even more depreciation. And so for me, when I was working at Hewlett Packard, some of the tech companies, and I didn't have many write-offs, this created a huge benefit to reduce my taxable income without taking cash out of my pocket. So real estate is that benefit of that depreciation really helps you do that. And if you want to sell a rental property, you can decide to do a 1031 exchange, which means if you find a like or similar property, you don't have to pay taxes on the gains from that initial sale. And so there's tax benefits from owning the property. There's tax benefits from when you sell the property. And so it makes it very, very, very tax efficient.
Thank you. I appreciate that. This is one of the ways to really accelerate the wealth creation, taking advantage of the tax side in addition to the passive income. A lot of folks want to know, when they heard the location of your properties, the first thing they're thinking is, how is that possible? You're all over the place in the country. So folks want to hear about how you chose your first property, like what that experience was, how you financed it, how you thought about that. And then as you kind of started to expand, how did you specifically choose the geos and the areas that you now have your portfolio based?
Sure. So I started in earnest looking at this thing back in 2003 and 2004, right? And so at that time, there weren't that many blogs around, so I had to read a bunch of books. I read books by Robert Kiyosaki. I hate to admit it, but I read a book by Donald Trump about real estate. And I also went to several real estate meetups as well to just learn about what other investors were thinking about, what they were doing. And so once I kind of got a sense of what real estate was about and how they're investing, as you said before, Brandon, I'm very analytical. I built the spreadsheet, okay? And based on what I read and who I talked to, I finally got a good sense of what the key measures of a good real estate market is. And it honed into 5 things: job growth, population growth, income growth, income to rent ratio, affordability. So I took all the metro areas across the US and stacked ranked all those metro areas based on this criteria. And I went to the very top, and it popped up Las Vegas, Phoenix, Miami. And at that time, those markets were all overvalued because there were a lot of folks going to the area. So I went to the second tier: Oklahoma, Texas, New Mexico. Once I honed in on that second tier, I decided to call local realtors in those markets. I talked to property managers, I talked to realtors. What's selling? What's not selling? What are some good areas? Who's moving in? Who are the big employers? And once you kind of have enough conversations, patterns start to emerge and develop a point of view on the market. And this led me to buying in Texas and New Mexico initially, and I followed this same pattern to expand into the Midwest. And so the one thing I did though initially that I would take back is I initially went for more appreciation than cash flow. And appreciation is a speculative thing. And so I thought there's going to be appreciation in New Mexico and Texas. It panned out well in Texas, not so well in New Mexico. And so I think in hindsight, I would have focused on cash flow in a good market and let appreciation take care of itself. And so I think that's something that I learned along the way. So that's why when I went to New Mexico, to Wisconsin and Indiana, cash flow and the appreciation is taking care of itself.
Got it. So thank you. I think that's really helpful to kind of get into the mind of how you thought about it. For those on the community who are just joining, Gravy is really a community to help move together towards this journey of wealth creation. It's a newsletter. It's a conversation series. AJ is the inaugural kickoff guest for the conversation series. And it's also a Slack group. So we encourage all of you to join because we're creating an ecosystem around all of these wealth creation topics. So AJ, folks want to know about the money side, the strategy that you use to finance these properties, maybe how you started, and if you made any adjustments along the way based on lessons learned. What did you do around that? Help people understand how they should be thinking about the financing.
So on the financing side, because I was making a decent salary on my tech career, I went the traditional kind of 20% down, 25% down, and I got a mortgage loan off of that. And so when I first bought in New Mexico and Texas, the price point was about between 125 and 160 for the purchase price. And so I put 20% down and then cash flowed it from there. The purchase prices in the Midwest are much cheaper. You can buy a house for $30,000, right? And so, but I still did the 10% down, 20% down, 25% down in those properties. And so typically I would save up a down payment and buy another house. Cash flow from any property, buy another house. And so I was trying to get pretty disciplined about using my savings, any kind of cash flow to get the down payment and buy another house. Other realtors or investors would typically try to do 100% financing, but for me, that was too risky. So I wanted to kind of get a down payment, finance the rest, and kind of cash flow it from there.
Thank you. And so just a real quick question. On the scale of 1 to 10, 10 being a very, very, person willing to take risk inclined person, 1 being you're taking no risk at all, where would you put yourself on that scale, which kind of informed your approach?
So I would say I'm more like I'm a 6, right? So I'm not the riskiest guy in the world, but I'm not going to be the most risk averse. And so for me, even within real estate investing, you can take a risk averse approach. So for example, the reason why I chose New Mexico and Texas is because if I had to fly there, I knew I could fly there and back and get back in one day, as opposed to flying across to New York or Florida, something like that. So I didn't go too far away from California. Once I kind of got comfortable going to Texas, going to New Mexico, I said, okay, I can do it even further out. And so I branched out to the Midwest. And so for me, I felt that once I got a chance to visit those areas, I got a team together of property managers, realtors, contractors. I kind of got a feel for them. I felt comfortable, and so I took a risk there. And the thing I would say is that you may lose money. And the thing I thought about is if I lose money, I will consider that an investment in my education, because I think that for me, I could have spent the next, the last 15 years analyzing this, analyzing that. But I think for me is just taking action was the most important thing for me. Once I did that, I realized it was not as scary as I initially thought in investing out of state.
That's a gem. Just get started. Go out there if you want to learn. All right, so
Yeah.
people want to get into the mechanics now, and you can start wherever you want to, but the biggest question is, all right, it sounds good on paper, but ultimately you are 100% dependent on your property managers on site to oversee your business. How in the world were you able to attract, find, and ultimately create a team that was going to help you, feel good about owning properties out of state, all over the place?
That's a great question. So for me, back when I first started, there weren't that many folks that did this. There weren't that many out-of-state investing. So I think it's a bit easier now because there's a lot of folks that's doing this that kind of set up. But for me, it all started with a investor-focused realtor. Okay, and I wanted to make sure that realtor had mostly investors as clientele as opposed to owner-occupied, because they know how investors think. They know exactly how to identify an investor-friendly property, and know how to work with an investor. And so for me, that was number one, getting a good realtor. Number two was how much experience do they have working with out-of-state investors? I wanted to find a realtor that the majority of their clientele were out-of-state investors. They knew how to use video, pictures, they knew how to work with you online, via email. So I don't have to train them all over again. So that was important number two. Once I kind of got the realtor to anchor my team, I'd ask for referrals for a property manager, for contractors, etc. And so for property management, that's one of the most important parts of your team. So for me, I wanted to make sure a property manager was, again, investor friendly. I wanted to make sure that they dealt with out-of-state investors. And I also tended to go with the larger, more experienced property managers. There were a lot of these mom and pop PMs out there that could get you a better deal. You can save money. Don't go for them. Go for the more established, reputable, larger PMs, because they're going to, in the long run, they're going to be around. These mom and pop places, they're going to be fly by night. They may go out of business. And so for me, I went for more reputable, flight for quality, these more reputable property managers. And from there, took care of itself. Now I've had some bad experiences for sure, but for the most part, it's been pretty good.
Got it. So I'm hearing a lot of questions coming up around just the diligence process, right? So just the simple fact that you build a team in one city and you're willing to move into a different city and basically reinvent a team there, you clearly have some criteria that you were using when you were doing your analysis and due diligence. First question is, what is your diligence process? How many properties would you look at? Just as an example, before you actually were willing to go to that next step. What was that next step? And then what ultimately led you to go to that finish line, particularly thinking through the pieces you need to be successful as you expand it.
Yeah, so typically it would take me about 15 to 20 offers to get something, right? So I'm very disciplined in my process. I'm very clear about the price I want to pay. And so once I hone in on the area, so for example, when I started honing in Texas, I said, what are the best areas for schools in this area? Where's the shopping malls? Where are the jobs? And I kind of pinpoint the zip codes in that area. And I said, okay, I'm only going to make offers in these 3 or 4 zip codes. Whatever comes up at this price point, that's going to be at least a 3-bedroom, 2-bath. And so it could be a 4-bedroom, 2-bath, but it has to be a minimum of 3-bedroom, 2-bath, single family house, because that's going to attract a family in a nice area, nice school, nice shopping. That's my criteria in the zip code. And so if I had to wait a year to find that, I'll be patient enough to wait a year to get that property. Once we kind of got something either an MLS on the public listing or off market, then I would kind of put an offer on there. And I would typically put a very aggressive offer. In some cases, I would put an offer in there that said, listen, I can get this thing closed in 2 weeks, 3 weeks. And so for me, I want to put it an aggressive offer with an aggressive close to try and win. But sometimes I put an offer and be no response. They say, go pound sand. And so for me, I honed in on the zip code, what my criteria was. I tried to stick with that as best I could and not try to fall in love with the properties. And so once I put the offer in and it got accepted, then we get into even deeper due diligence. My property manager would go in there and give me a sense of what we could rent it for. I'd have an inspector inspect the property from top to bottom, send me a report. I'd have an appraiser go in there, can appraise it from top to bottom, give me a report as well. And if all those things checked out, then I would close the deal. But for the most part, my realtor would help me quarterback that whole process while I was here in California.
Helpful, thank you. Let's talk about returns. When you were doing your diligence on the front end and you were thinking through how you can make the numbers work, what returns did you have in mind, and what of your returns would you say you can say you've realized at this point on your properties?
So when I first started investing in New Mexico and Texas, I looked at primarily appreciation. I wanted to have a property appreciate at least 10% a year, which is actually pretty unrealistic. And so when I started looking at cash flow properties, the primary thing I looked at as far as the return metric was cash on cash return. And my hurdle rate is 15%. If I run my numbers in my model and it doesn't get out to 15%, I'm not going to look at the property anymore. If I put the numbers in my model and it gets to 15% or more, I'll take a deeper look at it. And so if I look at my returns in the overall portfolio, it's about 17.6%. The returns are actually a lot higher in Indiana. They're closer to 35% returns, cash on cash returns. And in Wisconsin, they're about 19% returns. If I look at my properties in Texas and New Mexico, again, it's more appreciation based and less cash flow. So the returns are less on a cash flow basis, but the appreciation has been great in Texas and less so in New Mexico.
Thank you. Switching gears a tad bit to the financing a little bit. There's really two questions that I think people may have. The first is, did you have a point where you basically hit a wall and you talked about putting offers in, can close in 2 weeks. It sounds like there may be an all cash offer. What type of partners did you work with, potentially either people or hard money lenders? Do you have one bank relationship that's doing all your national work, or did you have to find different bankers in every area? People are kind of curious to understand how you actually approach getting these deals done and getting them done quickly.
So this is a great question, because initially I was doing like 20% down, 80% financing, but I did hit a wall. Once you get about like, in some cases 4 loans for some banks or 10 loans, you hit a wall. So I had to get creative. And so what I did was, for my Indiana portfolio, I found a local bank, and they were able to, and I had this mutual fund at Vanguard that was sitting there just plodding along. And I said, what's the best way for me to leverage my assets? And when I was talking with the banker, and he said, listen, if you allow me to use your Vanguard mutual fund as collateral, I'll give you a home equity line of credit up to X amount. So you can borrow whatever you want with that home equity line, with that line of credit. And so I basically gave him as collateral my Vanguard mutual fund, and he gave me a line of credit, and I used that to finance my Indiana portfolio. And within Wisconsin, I found this credit union that didn't really care about how many properties I had. They cared about my personal balance sheet, and they allowed me to exceed the limit for the number of loans, and got a great deal with that credit union. And so I think in Indiana, using my mutual fund as a collateral is a creative way to doing that. I've also decided to use, and I don't advise this for everybody, is I used a low-cost margin loan at one of my brokers to also finance some property as well. Again, that's something that's more risky for some people. I wouldn't recommend that, but I've done that as a way to kind of get around some of the limitations on the financing.
A lot of gems in there. I think that's a lot to unpack. And you basically kind of went into different markets and just kept looking for financing partners as you ran into barriers, research, talking to people. Did you use any resources like some of the RIAs in different areas? How did you approach community? It sounds like, at least the way it sounds to us, is that you've been pretty much a solo flyer.
No, I think that I rely on a lot on my team locally. So the way I got to that banker in Indiana was through my property manager. The way I got to the credit union in Wisconsin was through my realtor. And so I think that being able to leverage your team and their contacts, I also was able to go to different blog posts now, like biggerpockets.com, and talk to people there as well to find out how are you getting financing, how are you getting money. And so I was just kind of hustling in biggerpockets.com and talking to different people, talking to my local team. And so that's how I was able to kind of find these different ways to finance the properties. But financing, after you get to a certain number of properties, financing, you have to be very creative, and it does add a bit more risk to the portfolio. So again, it's not for the faint of heart.
Thank you. So people want to understand the setup process. LLC for every property. Can you go through what you've learned to be is the best structure for people to get started, and then also any other tips that you would advise based on what you learned in terms of things to think about as you're setting up front?
So that's a great question, because initially I did everything by the book. I set up an LLC for each state I was in. So LLC for New Mexico, LLC for Texas. And it just got more complicated when it came to taxes. And it got more costly to maintain the LLC. And one investor I was talking to was saying, what are you trying to protect yourself against? And I said, well, I'm trying to protect against any kind of lawsuit or getting sued by somebody. And he said, listen, you're renting out these units to kind of these blue collar folks. They're paying $1,000 a month in rent. Are they going to hire a lawyer to sue you and to sue you because something happens on the property? And so after I had that conversation, I said, maybe he's got a good point there. So I have not done an LLC for the Indiana or Wisconsin properties. I still have my Texas and New Mexico LLC, and I'm kind of torn whether or not the LLC is good. I think if you want to have some extra protection, I would do that, but it just felt, for me, at least for me personally, it got a bit too complicated. But I think that there's merit in having the LLC protection for your property. And I would do it per state, but not per property.
Got it. Super helpful. And it's good to keep in mind you're a 6 on the risk scale, which means that I would say, knowing you, I think you're relatively conservative. And so I think in a lot of ways, what Gravy is about is being really transparent. I appreciate the fact that you've been open about these trade-offs and kind of decisions you've had to make. And Sometimes it's about moving forward and kind of accepting that risk. People want to hear about some horror stories. So at this point, you have, I think, 53 doors. Behind every door is a person or a family, and you're all over the place, and you're focused on, the blue class area. Just kind of curious to hear, if you were looking to have somebody run off if they weren't serious about this thing, what story would you tell them?
So again, it has not been all roses, but I think the toughest one is actually something I'm going through right now. So I bought a mortgage note from a felon. Okay. And so I try to do something like adjacent to real estate by buying a mortgage note, which I'm the banker. I'm going to lend an investor money so they can buy a property. Okay. And so I talked to this guy. I met him via a wholesale website. It was $20,000 mortgage note. And I talked to him. He seemed very respectable, seemed very nice. But for some reason, I didn't check his references or do a simple Google search. Okay. And so after about 5 months after I bought the mortgage note, he stopped paying. I called him, I emailed him, no response. I get the police involved, and it turns out this guy has been convicted of securities and wire fraud. Okay. So I'm like, damn. So at this point, I hire a lawyer to get ownership of the property. We go through a sheriff's sale. That took me 9 months and 10 grand more dollars to get that together. And when I finally got possession of the property, it was totally trashed. It was totally kind of just in bad shape. So I did a little bit of cleanup with my contractor there. And now it's on the market now. I'm selling it for $10,000. It's in contract now to be sold, but I'm out $20,000. And so I think the lesson for me there was don't take any shortcuts and know when to cut your losses. I probably should have said, once you stop paying, I should have said, you know what, I'm good. I'll just write it off. But to drop it another 10 grand to get the property, probably a mistake. And so that's one of my horror stories.
I appreciate that. A little nuance you dropped in there. You said, and so you're selling it right now for $10,000. And I think this ties into a question that I've seen come up in the chat as well, which is really, a kind of a multi-pronged question. You can take it where you want to, but a lot of folks are trying to buy a primary residence, right? That's technically in a real estate class. You mentioned, as you kind of did your net worth allocation, how much, your real estate included your home. How would you think about that trade-off of buying a home versus investing in real estate for cash flow as someone who bought a home and had to make that decision yourself?
So is the question whether you should buy a home for yourself versus buy investment property?
Exactly.
So, it really depends on what you're trying to achieve, right? So for me, I did buy a home first. And I think that buying a home, although some don't consider it an asset, this asset that I have owned has really kind of helped to appreciate and drive up my net worth. And so I would tend to want to buy a home first, because I think that's something that's important to kind of start with home base, and it gives you a good kind of foundation to go off of. But I've seen other folks who are renters who've purchased multiple properties. So I think it depends on what you're trying to accomplish. If you're trying to build up a portfolio, if you're trying to do like a fix and flip, or you're trying to do a live-in or house hacking, not being tied to a house could work. And so it really depends what you're trying to achieve. So it's hard to say kind of black or white if it's good to kind of invest first versus buying a home. But for us, we bought a house first, and then we started to invest.
And you did it in the Bay Area, which says a lot, because I think depending on where people are located geographically, that's a it's a different level or a different type of conversation. But it's a good segue into the next phase. So we talked about real estate, but the reality is you're also a very successful executive. And so I think to really understand the full picture, we need to understand the time commitment. How were you able to juggle these responsibilities that you had at home as well, at work, and then kind of managing your property portfolio? And what best practices would you share?
Yeah, it's a good question. So I've always strived to be as productive as possible, like in all parts of my life, right? So if I can try and automate something, I'll do it, right? And so if something as simple as paying my bills automatically or managing the kids' activities, that's important. So the three most important tools in my life are to manage my time is my email, my calendar, and a cloud-based to-do list. I cannot live or breathe without these tools. They're on every device I own: laptop, desktop, iPad, phone. And I check it several times a day. So when it comes to email, I am an inbox zero kind of guy. And the way I manage my email is very, very specific, right? So I subscribe to a lot of newsletters and blogs, but instead of having that hit my inbox, I got a filter set up where it goes right to a news folder. And so I'll check that 2-3 times a week as opposed to clogging up my inbox. And when I log into my Gmail, I have a customized, you see 3 inboxes. You see my main inbox, you see a follow-up inbox, and you see a do something inbox. And so when I see an email, I do one of 4 things. I read it and reply right away. I read it and delete it. I read it and put it into the follow-up inbox to follow up on it later. Or read it and put it in the do something because I have to do something to kind of close that email out. So when I block time on my calendar to go through email, I go right to the follow-up inbox and the do something inbox to clear that stuff out. And I do that pretty much every day. When it comes to my calendar, if it's not on the calendar, it does not exist. That's my motto. You can ask my wife, my kids, they go crazy with that, but I'm maniacal about working the calendar. And so not only do I schedule events and meetings on my calendar, but I schedule time to do stuff. So if I have to come prepare for this webinar, put an hour on my calendar. Got to look at some rental properties, put an hour on my calendar to do that as well. And so when it comes to my meetings for work, I only take meetings between 10 a.m. and 4 p.m. I try to keep to this as best I can. Before 10, I'm working on stuff, I'm thinking, I'm doing stuff. After 4, preparing for the next day. I used to have meetings from 7 a.m. to 7 p.m. I just couldn't get stuff done. And so 10 a.m. to 4 p.m. is my meeting time. I typically have a no meeting on Friday rule. So Fridays, I spend my time working, thinking, preparing for the next week, thinking back to the last week. So I try to have no meetings on Fridays as well. So that's how I try to manage my calendar time. When it comes to my to-do list, so I have this cloud-based to-do list. It's called Toodle-Do. There's a bunch out there, but I use Toodle-Do, which is TOODLEDO.com. I have a terribly bad memory. And so I have to write everything down. And this to-do list helps me prioritize things. So when I put something in there, I put in what I got to do, when it needs to get done, what category it's in, either real estate, personal, kids, whatever, and what's the priority, high, medium, or low. And so when I open it up every morning, I have a good sense of what I got to do for that day. I also happen to be an early riser. I get up between 4:30, 5 o'clock every morning. I start with a workout. It just helps to kind of get my day started. I do a Bible study and I get stuff done in the morning time. And I love it because it's dark, it's quiet, everybody's asleep. So I get a lot of good stuff done in the morning time. On the real estate front, I use a program called Stessa, STESSA.com. It's like Personal Capital or Mint, but for real estate investors. It takes all my real estate transactions and puts it into a program where I can kind of run reports on it, see what's going on, and it creates a dashboard so I can quickly check on what properties are doing well, what's not doing well, and that helps me to prepare for talking to my property managers about the property. So Stessa has been just a huge thing for me to do to get everything kind of together into one platform.
Wow. I love how specific you got with that, because I think at the end of the day, it comes down to process. And it sounds like probably above all, you're a master of process. Can you talk a little bit about just kind of diving into the family side? Things come up unexpectedly as you kind of manage your business portfolio. You try to calendar everything, you try to be really organized, but the reality is some things are going to pop up here and there. Can you come up with an occasion or maybe like an anecdote around being at work or being home with family and then something goes down and really having to kind of tackle that, but also defend the situation that you might be in where you have to step away and focus on this, fire drill related to real estate?
So if it's a fire drill with family, there's no question. I'm gonna drop everything for family. I've done that before. I'll do it again. Everybody knows family comes first. So fire drill with my kids or my wife, everything just goes away, and I got to deal with that. When it comes to real estate, I think that the fire drills happen, but I think that I have a good team in place on the ground to help me deal with it. So it's funny. So yesterday I got an email from my property manager. She told me that a car ran into the side of this duplex I have in Indiana, and it created some structural damage. And so I was like, oh, just great. So I emailed my insurance broker. I connected with my property manager. They're going to file a claim and take care of it. They're going to send me a report about this tomorrow. And so, if I were earlier in my investing career, I would have panicked. But I said, listen, I got insurance. I got a great PM on the ground to take care of this. And so it's going to get handled. And so I think that having that trust and confidence in that team, if something does come up unexpected, I have the confidence they can get it done. So I think that the fire drills on the real estate side, sometimes it happens, but having a good team helps me to deal with it.
Got it. Thank you. I appreciate that. Basically, kind of, again, it boils down to a system and being calm and collected about things that come up, thinking rationally. All right. So AJ now has gone through a lot, been through a lot. You kind of build out these processes and systems. What advice would you give to the younger version of yourself, maybe coming out of college, around how to, really, really lean in and get even a better trajectory on the wealth building journey at an earlier age?
So I think one thing I would say to my younger self is from the very beginning, think about real estate investing as a business. Okay. Think about your customer is the tenant, your team or your employees are the realtors, the property managers, the contractors. And so I've been working in business for like 25 years. So I know how to think about growing a business and cutting costs in the business and making it profitable. Why not apply that to my real estate portfolio? So I think that it took me longer than it should have to really take the lessons learned in working in business and applying that to my portfolio. So I started thinking about what can I do to make this more different and differentiated from everybody else. And so what I've done with my tenants, my customers, is every Christmas, I send them a Christmas card. I give them a gift card in there. Not many other landlords do that. For their birthdays, I send them a birthday card and a gift card as well to create that affinity. If you're a long-term tenant that's been a good tenant, I'm not going to raise your rent. I also kind of give year-end bonuses to my realtors, my property managers, and my contractors to create that connection and that affinity. And so treating it more like a business and how you want to try and create loyalty with the employees, delight your customers. I should have done that from the very beginning. It took me a while to get there. And so I would change that if I could. And I also talked about this before about the appreciation versus cash flow. Earlier on, I focused on appreciation. That was probably a mistake. So for some folks that works. For me, I don't think it is the best approach. So I think I would have told myself to invest in cash flow, and let appreciation take care of itself. That's what I would have told myself.
I love that. Very detailed. Sorry about that. So let's look towards the future. You're a humble guy. You don't really, knowing you don't really toot your own horn. I think I may have known you for maybe 5 years before I even knew you owned a property. So you kind of roll under the radar. So I appreciate the fact that you're kind of stepping up to tell your story and helping others, really try to find their way on this wealth journey. What are your goals moving forward? Short term, long term. Where are you going? What are you looking to do? As your situation is now a lot comfortable than when you started, you have more options, and you have an opportunity to kind of reflect on those things. So curious to know, what does success look like to you moving forward?
You're getting deep on me, man. You're getting to the Oprah-like question now, man. Gee whiz. So I think what's next for me, I think that I'm at the point now with my real estate portfolio where I think I'm good. I think that I'm at the point now I have a manageable amount of properties, throwing off sufficient cash flow, and now I want to start to give back more. I want to be able to share my story. I want to be able to consult and advise people on real estate, investing, building wealth. I want to do more of that. So I think that's why I wanted to kind of come on this conversation to talk about my story. If I can inspire one person to take action to kind of build wealth and change the trajectory, then my job is done. So I feel that I've had so many blessings, and I want to kind of pass it on and be a blessing to somebody else. And so what's next for me is sharing my story, sharing any tips and tricks that people want to hear about, and trying to help people build wealth on their own and to get on their own journey.
Got it. And I guess the final question is, retirement. You've been working for a while. You've made it to the C suite of a publicly traded company. You're one of a very select few folks within the Black community that have been able to kind of get to that level. How do you think about retirement, like the actual idea of being able to step away? You're talking about your passions, but that's also in some ways a financial decision. What framework, what methodology are you using to kind of think through, at least for you, what's the ideal age or time to retire?
Yeah, it's funny. So retirement can be a taboo word because it means different things to different people, right? So retirement can mean to some people being on the beach, not doing anything. Retirement can also mean kind of launching another career and doing your passion project. I think for me, I'm happy with what I'm doing. I love what I'm working at. I'm having a lot of fun. If that changes, then I start thinking about what's next for me. I think that if I do decide to go on eventually at some point in the future, it's going to revolve around personal finance, wealth management, but I want to target the youth as well. I think that teaching kids in middle school, high school about investing, about balancing a checkbook, those are some life skills you need to have. And these kids come out of high school, come out of college, not knowing how to think about investing or building wealth. And so I want to be able to do some of that if I eventually retire, to just kind of spread the word to our youth and to other folks that want to hear about it.
Love it. Leslie, thank you. In the last 10 or so minutes, I'm going to unmute you here. I wanted to see if there's any other questions that the audience has. You should be able to speak now. Let me know.
Yes, we've gotten quite a few questions from the audience. So thank you all for being so engaged, and AJ for sharing your story. Oh my gosh. So let me see if I can go through a few more questions from our audience. So Nathan May just asked, what are your biggest cost saving tips when you're fixing up and buying and holding a property? And where do you think people tend to overspend?
Yeah, I think the biggest area that people tend to overspend is the kitchen and bathroom remodel. I think just getting some basic appliances, stainless steel appliances, some regular kind of Kenmore G appliances, getting typical kind of just light neutral colors in the bathroom. That's where you can save a lot of money. People tend to want to. I think the mistake people make is they want to renovate it as if they live in the property. Right? It's not for you. It's for your tenant. It's for this certain market. It's for this blue collar. You know, you're paying $500 a month in rent. That's going to attract that kind of tenant. Don't make it the Taj Mahal. So people tend to think about what they would want to live in and overspend that way, and they tend to overspend more kitchen and bathroom. Keep it basic, and also look at other properties in the market, and don't over renovate it to be too much above the local properties in the area as well.
Thank you for that. Another question we have is, do you ever partner with other people when you're buying these properties, or have you pretty much been going at this solo? And if you have partnered with a friend or a colleague, what has that experience been like?
So I have not officially partnered with anybody, but I've had some opportunities in the past, but it just never quite happened. At this point, I don't think it makes a lot of sense for me now. But I think if you do decide to partner with somebody, you got to make sure you guys have the same goals in mind. You guys are similarly financially situated, and make sure you think about the escape clause. If something goes wrong, what's going to happen? Who gets what? Because when things are all rosy, it's all fine. But when things turn bad, and it may, then that's when people start to change. So just be careful who you're going to partner with, and make sure you know what the contingency plans are.
Great, thank you. And along those lines, how did you find a good attorney? Is that something that, you were referred to a good attorney? Did you Google them?
It was a bit of both. So I leaned on my team in these local markets for referrals. And then I also looked at various websites that had Yelp reviews on attorneys. And so having an attorney in each market is very, very important, because every market is different. They have different local laws, bankruptcy laws, eviction laws. And so it's very important to have that. So I got that from both referrals and from looking at Yelp online.
And was that a similar process for selecting your tax advisor?
So I got lucky. So I got my tax advisor. I went to a real estate meetup about 10 years ago, and this guy gave a presentation about tax savings for real estate professionals, et cetera. And he kind of blew me away. So I ran into him afterwards. We exchanged cards. We started talking. He's been doing my taxes ever since, and he saved me just a ton of money with his tips. And the thing is, this guy is like a tax savant. He loves the tax code. He lives and breathes the tax code. So I know I'm in the right hands with this guy. So he's been fantastic. So I got lucky with that one.
Is he accepting referrals? You mind sharing his name? And we might have some people in the audience who need to reach out.
Happy to do it. I'll give the information to Brandon and Leslie. Happy to do it.
Oh man, okay. So AJ is giving it all to the people. And one of the things about Gravy I want to emphasize is it's really, a community that's for the community. It's not folks who are looking to sell anything. It's really looking to help people move, through on this journey together. And AJ, again, applauding you for, taking your best resources, your best gems, and sharing that with the people. Leslie, back to you.
Thank you. Another question we had Did you factor in tenant protection laws when choosing your markets, such as, the Bay Area and California being pretty difficult for landlords?
Actually, I did. I think that yeah, some states are, more landlord friendly, more tenant friendly, and so it all boils down to the eviction laws in the state. And so, for the most part, I'm in, pretty landlord friendly areas. But that all changed during COVID, right? So if during COVID they had put a moratorium on evictions, but for the most part, pre-COVID and hopefully post-COVID, the states I'm in are pretty landlord friendly, and that was a factor, but a small factor in me selecting the markets I'm in.
And did that shape your experience as a landlord? Did you have to deal with a lot of tenants who weren't paying their rent because of they lost their job or they just took advantage of the law?
It made me even more attracted to real estate because my equity portfolio Vanguard dropped a ton, but my cash flow from real estate kept on coming in every single month. And the reason for that was because even though some of my tenants lost their jobs, a lot of these markets had rental assistance programs that allowed them that paid the rent for them when COVID hit. And so I was minimally impacted by COVID on my real estate portfolio, but I got more exposed. I had a bigger drop in my equity portfolio. So for me, it proved out even more that real estate is very resilient and not correlated to the market.
Oh, that's awesome. And is there a certain point where you would consider selling a property, or have you done that before? Aside from, I think, the case where you had the really horrible tenant.
Yeah, so when I started out in New Mexico and Texas, and New Mexico didn't work out as well as I thought, so I sold a few properties there, did a 1031 tax-free exchange, and that's how I got to the properties in Indiana and Wisconsin. And I'm also, always looking to cull up property. So you can have the best projections in the world and have the best set of numbers, but the reality may be different. And so there are a couple of properties that are not quite pulling their weight. They're not above the 15% hurdle rate that I have. And so I'm thinking about selling those properties, but I have sold properties, but I tend to want to hold on to them as long as possible. So I think it'd have to be consistently below my hurdle rate for me to want to sell a property.
Someone just asked, so why 15%?
So for me, I could get like 8% in the market, and that's like really passive. And it won't be great tax wise, but I get 8% in the market. In real estate, it takes a bit more time, a bit more complicated, a bit more risk. To reward me for that risk, I want a high return rate. And so I said to myself, and it was arbitrary, I said, okay, if I can get 15% on my properties, it's worth the risk and the time to get this together and to get it stabilized. And so that was my personal rate. Some folks have a 12% rate, some folks have 10% rate. But for me personally, I thought that to reward me for the additional risk and time I'm putting into this, I want to have a higher return.
Awesome. Thank you. Couple more questions. I know you've answered so many questions tonight. Thank you so much again. Let's see what other, would you consider investing in other markets? I mean, I know you said you're pretty much finished building out your portfolio, but just for the heck of it, have you thought about maybe investing in other markets, maybe markets that you consider in the beginning but chose not to?
So I thought about looking at like Detroit and Cleveland areas because they got so beaten down, but I think that they're on the rebound. So I thought about those markets. If I could invest in Texas, I would, because I love my property manager. I love the economics there, but the appreciation has gotten too high. It was hard to cash flow in Texas. Nashville, I think, is a pretty cool market that I've looked into, but didn't pull the trigger. So there are some markets where I think that it's sort of untouched by investors that have some good potential. But I think I'm pretty set right now on the four markets I make. I know the markets very well. And if I can't find something there, I probably wouldn't do anything. But if I do invest in another property, it's more likely going to be in those four markets as opposed to a brand new market. Because the brand new market, I got to bring up a whole new team, learn the market, et cetera. So I'm not at that point where I want to bring up a whole new team in a new market.
All right, AJ, in this last couple minutes we have here, I just want to thank you again. And I know as you kind of think about giving back, which is something you said you're going to be looking to do a little bit more moving forward. How can people stay connected with you? How can people, hear more about what you got going on? And as you move more into this space, how can people, stay in tune with what you have coming up?
So in the spirit of wanting to really kind of to give back, I created an email. So my email is hopefinancial21@gmail.com. I'm happy to talk to you one-on-one, to advise you, to consult you. I think that it's just my way of trying to give back because again, I was mentored along the way and I want to pay it forward and mentor other people along the way. And so if you want to reach out to me, connect with me, the best thing to do is send me an email, and that's hopefinancial, the number 21 at gmail.com, and I'll try my best to respond, to connect with you, and to help advise you. So it's something that I'm trying out that's new, but I'd love to talk to you about your journey, maybe help you along the way, and see how it goes.
Love it, love it. And again, we want to thank you, AJ. You know, even the email address is a Gmail address, not selling anything, just telling this story, giving you the game, and that's what Gravy is all about. With that said, I want to thank Leslie for being an incredible co-facilitator in this session. And I want to close out by reiterating that Gravy represents right now 3 focuses. It's this conversation series, Unpacked. We're bringing you guests every month. The next event, I can announce now, it's going to be Thursday, February 25th, and it's going to be joining a corporate board. And it's going to feature Andrea Clark-Veneto, who is in her 30s, and she is a Black woman on a public bank. And so she's going to talk about her experience. We have a newsletter, comes out weekly on Thursday or Fridays. And we also have a Slack community. And Leslie, I believe, populated the link in the chat here. So get involved, introduce yourself, ask one question on the Slack group. That's what we're asking you. Everything is free. Everything is to move us forward together on this wealth journey. And with that, I want to salute AJ. AJ, you've been an incredible guest. Maybe we'll bring you back as you kind of enter into that next phase. AJ has kindly volunteered to join the Slack group. He's already a member there, but specifically to answer any questions that you may have about his real estate journey. So it's going to be kind of an AMA, if you will. So feel free to hop in that Slack channel, and AJ will be there to respond. With that said, we're at 5 o'clock. Thank you again for joining us for the first inaugural Gravy Unpacked. Look forward to bringing you more quality sessions. Thank you, everyone.
One last thing.
Go ahead, Leslie.
So Sunday, 2 of our Gravy members will be speaking about how they bought a business. And this will be done through our Slack channel. So you'll be posting your questions, they'll respond through Slack. It won't be a video series, but it will be Sunday at 10 a.m. Pacific Standard Time. So you will need to join the Slack community to ask questions.
All right. Thank you, everyone. Thank you, AJ. Thank you, Leslie.
Thank you.
Bye.